Might kick off. So again, welcome everyone to our May webinar, which is Demystifying Management Liability. My name's Brenton Fielder. I'm a senior underwriter based in Melbourne. I'll be presenting along with my colleague Susie Lubick, who is also a senior underwriter but based in New South Wales. So before we start today's session, we'll just run over a few housekeeping topics. So today's webinar will be recorded. The link will be sent out to you in the next couple of days, but alternatively, it'll be available on our website within the next week. During this session, we encourage any comments or questions from yourself. There is a Q&A section on the webinar where you can write any questions that you may have, and we will have a Q&A at the end. Throughout the session, we'll have a couple of polling questions via Slido. The question will pop up and you're able to put in your responses. We'll then reveal the correct answers. If you're having any issues with the sound, please try to disconnect and reconnect or use the call-in number that's provided in the audio options on your screen. If you can't see the presentation, please make sure you're using the WebEx app and not a browser, or you are outside of your company's server. And lastly, in regards to CPD and CIP points, we'll email out a certificate to you, which you'll then be able to go and claim your points via the NEBA and ANZIIF website. First, Slido question, which should be coming up for you now. I'll just wait for that to appear. So the first Slido question, who needs an ML policy? Is that working for everyone? I can't see it on my end.
Coming up.
There we go, sorry. Thinking about it. Who needs an ML policy? So we've got four options there. It looks like it's sort of petering out now. Yep, so we'll call that the end then. And the answer is, as most of you have suggested, all businesses, big and small. We had 91% of the people select that, so well done. Yes, ML is suitable for any company, whether they be a sole trader, an incorporated entity, or associations. We're going to hand over to Susie now, who's going to go over the next few slides for you. Susie?
Thanks, Brenton. Welcome everybody. So we're going to touch on management liability. So what is management liability? So it's obviously a product designed to cover liabilities incurred in the management and administration of a business, so i.e. Running of the business. So basically, management liability, when we initially started underwriting this product, it was designed for your private entities, but now it's pretty much expanded to incorporated associations as well as companies limited by guarantee, i.e. clubs. So we're going to go through the policy structure for a management liability policy. So they're claims made and notified. The limits and deductibles are cost inclusive. We've got the insuring clauses. So the insuring clauses are the gateway to the policy. So the policy needs, the insuring clause needs to be triggered by the insuring clause needs to be triggered for the policy to respond. So then we have extensions. So the extensions parts of the wording allows you to decipher what is covered under the actual policy, and then the exclusions tells you what we're not covering under the ML policy. Under definitions, it defines the scope of cover as well as the special terms within the wording, and then you've got the conditions, which usually includes a confidentiality clause. So basically, ML will protect directors and officers as well as the company against any wrongful act committed in the management of the company. So next slide, Brenton. So we're going to cover the insuring clauses within our management liability wording. So the first insuring clause is your directors and officers liability insuring clause. So We're going to read out the insuring clause 1.1. So we shall pay to or on behalf of any insured person loss arising from any claim for a wrongful act which is first made against the insured person during the policy of insurance and notified to us in accordance with the terms of this policy, except when and to the extent that the company has been indemnified by the insured person. So this insuring clause, what it means is that we're actually paying claims made against, or any claims that are made against the directors and officers. So some of the kind of exposures we see for the directors on this insuring clause is the director's duty. They must have a duty of care, skill and diligence. They must act in good faith and work in the best interests of the company. They need to exercise a duty of powers and use information for a proper purpose, not for personal profit. Duty to prevent insolvent trading, as well as duty to avoid conflicts of interest, duties relating to company records. You know, people can go after personal assets and liabilities of directors and claims against directors and officers. So some of the claims examples we found in this insuring clause relates to breach of fiduciary duty. Basically, the claimant sued in relation to an investment in a company, claiming they were entitled to a certain percentage of profits. The claimants alleged the directors failed to disclose the existence of a number of agreements which would affect the claimant's profit levels, which constituted a breach of trust and breaches of equitable duties. So we've got another claim example of restraint of trade. So a claimant commenced proceedings in the Supreme Court of Victoria, alleging their past employee, now employed by the insured, had breached his restraint term. Clauses in his employment agreement by soliciting, canvassing, approaching or accepting approaches from customers or clients of the claimant for the insured. It is alleged the director knew or was recklessly indifferent to this breach. So here are some claims examples that we've seen from the insuring clause 1.1 under directors and officers liability. So if we go to the next slide, company reimbursement insuring clause 1.2, we shall pay to or on behalf of the company loss arising from any claim for a wrongful act which is first made against an insured person during the period of insurance and notified to us in accordance with the terms of this policy, but only when and to the extent that the company is permitted or legally obligated to indemnify the insured person. So essentially what this clause means, if the company indemnifies the director or officer for such liability, it would be entitled to be covered under the company reimbursement section of the policy. So if we go to the next slide, Brenton, insuring clause 1.3, company liability. We shall pay to or on behalf of the company loss arising from any claim for a wrongful act which is first made against the company during the policy period of insurance, if notice thereof is provided to us in accordance with the terms of this policy. Essentially, what this clause provides cover for the company covers the company against claims or alleged or actual wrongful acts. So basically what we've seen some exposure in this insuring clause is against the insured by regulatory authorities like as in your ASIC, ACCC, EPA, Fair Work. It also can get claims made against employers, shareholders, customers, creditors, competitors, claims against companies. So some examples that we've had here on this particular clause was we had an ACCC investigation. So the insured had received a notice to produce from the ACCC alleging the insured had engaged in anti-competitive behaviour, including amongst other things such as price fixing. Another claim that was made against companies in this insuring clause was defamation. Claimants are claiming defamation and reputational damage as a result of content posted by the insured in a social media post. And another example we have here is restraint of trade. So a claimant commenced proceedings in the Supreme Court of Victoria alleging their past employee, now employed by the insured, had breached their restraint term clause in his employment agreement by soliciting, canvassing, approaching or accepting approaches from customers or clients of the claimant for the insured. So as I said previously, your insuring clauses are your other gateway to the policy. So we've got 3 insuring clauses under our ML. So we'll touch base back on that. So you've got your directors and officers, which covers any claims that are made against the directors themselves. And then we've got the company reimbursement. And then the final insuring clause is your company liability, where we cover claims made against the company. So how does that differ to D&O? So remember, D&O provides cover for the directors only, and management liability covers the directors as well as the company itself. So that's me.
Thanks, Susie. I'm just going to go over a handful of the automatic extensions that comprise a management liability policy. This is not an extensive list. I think we've got 20-something extensions on 24 extensions under our automatic extensions for the management liability. And we're just going to go over these ones that are listed on this slide now. So outside directorship, statutory liability, tax audit costs, employment practices liability, employee theft and customer or contractor crime, and then runoff cover. These are some of the main parts of a management liability policy where we see either questions coming in for or claims / notifications being made under. So we'll start with outside directorship. So outside directorship is cover for an insured person who, at the written request of the insured company, acts as a director or officer for an outside entity. Now, this can be in relation to you might be working within a specific industry, and there might be some industry associations that provide, training and support for that specific industry. And you may be, as a director of a company, you may be asked by the company to sit on that board, and they will ask you to sit onside that, and that will be your outside entity cover. Another situation could be there is another company that the insured company has a shareholding in, but because they're not the major shareholder, it's not deemed to be a subsidiary, but they still want to have that director or officer sitting on that other entity. The next clause is your statutory liability. This is a very interesting one because the laws have been changing in the last year or two around what can and can't be paid in relation to statutory liability. So our statutory liability covers for fines and penalties and associated legal costs where it is permissible by law. So where it's not permissible by law, our policy will still respond in terms of supporting the insured for the associated legal costs and defence until it comes at such time as there's a judgment made. If we can't respond, if our policy can't respond to pay that, then obviously it won't. If it can, it will. The last one on this page is your tax audit costs. So this covers for tax audit costs for the insured entity only. This is not for the directors or officers' personal tax. This is for the company, the entities noted on the policy only. So our tax audit policy will extend to include ATO reviews, and will pay tax audit costs reasonably incurred by the company up to the completion of the audit or the end of the investigation. I'll move on to the next page now. We're going to look at employment practices liability coverage. This is an area that the next two are areas where we see quite a bit of movement in relation to circumstances being notified and claims being lodged. So employment practices liability entity cover is covering the entity and individual Ds and Os in relation to employee allegations of unfair dismissal, employment terminations, harassment, deprivation of career opportunities, basically anything that an employee can deem to be unfair against them can be put under this policy extension. I need to highlight to all and sundry that this doesn't necessarily need to be a founded allegation. Any employee at any time can make up a story about any other person and lodge a complaint, which could go via this, which is another reason why management liability policies are so important for your insureds, because anything can be made up about this stuff. Any person can allege that they were sexually harassed by a manager or a team leader or a senior partner, and they can be quite costly in terms of the investigation that goes behind. And then also if there's something deemed to be found untoward, that the payout could also be significant as well. Next one is our employee theft and customer or contractor crime. So this is for cover for the entity in relation to fraudulent or criminal acts committed by an employee, contractor, or an identifiable customer. Please note that this does not relate to social engineering cover. This must be from an employee, a contractor, or an identifiable customer. It can be in relation to anything within the space of an accounts person has set up a dummy bank account to pay invoices in without getting the prior approval of more senior management. It can be the actual physical theft of equipment from the office. So this is quite a big part of the policy that responds under our management liability. The last one we'll just touch on now is your runoff cover. So runoff cover is following a takeover, merger, or liquidation/administration of the company. In the event that the runoff clause has been triggered, the policy will automatically convert to a runoff policy for the remainder of the policy period. The insured then has the option to purchase up to 7 years of further runoff. And this is done on a case-by-case basis and charged accordingly. Effectively, if there's a sale, a merger, or an acquisition, so if the sale of the company of 50% or more of the voting stock, we deem that to be a change of ownership, and that will then trigger the runoff clause. Some entities, as part of the sale, will have written into their contracts that the incoming owners will take on all the past and prior liabilities. In that situation, often the runoff is not taken and the policy will just expire and the new entity takes out a new policy. However, if that's not written into the contract of sale, the outgoing parties are often required to have a runoff cover to cover any prior acts prior to the date of sale. I must highlight that when there's an entity that's gone into administration or liquidation, it's very likely that we will not consider to offer further runoff as there's no deemed legal entity and the administrators are not able to advise anything on the policy because they're not the insured entity. Okay, so we'll go on to the next Slido question, if we can get that up on the board. I apologize, my Slido question seems to be a bit delayed, so I'm not sure when it's coming up for you guys. But the question is, when is a claim notification required? So we'll just give a little bit of time for this to be done. So you've got your 4 responses there. So we can see that there's 2 that are kind of neck and neck, or they are exactly the same at the moment. Oh, nope, we dropped back down. The responses seem to be slowing down a little bit, so we can reveal that the actual correct answer is all of the above. Obviously, claims need to be notified during the policy period. We would hope that an insured would notify or at least discuss with you as the broker when they've become first aware of any situations that could potentially give rise to a claim, and definitely need to be done prior to the policy expiry date, or else you can come into notification issues and disclosure issues. Just on that, a lot of times, especially with a management liability policy, insureds aren't overly aware or overly confident around how and when a management liability policy can respond. We've seen many times where it's come up time for renewal that they've answered yes to one of the claims questions, and when we've gone back and asked further details, because we don't have a notification on file, it's at the 11th hour when the client is completing the proposal form that they have that memory like, oh, someone raised an issue with that, or someone raised an issue with this. So they'll say yes, not knowing that they should have called their broker straight away to disclose the event that happened, so that the broker could then notify us of a potential circumstance to get notified. It really does need to be done prior to that current policy expiry. It can come into huge issues if it rolls over. Keeping in mind that if we receive a management liability renewal submission at the 11th hour, we're not able to quote terms until we've gotten to the bottom of why they've advised yes to one of the claims questions, but we don't have anything further on file about it. When you're talking to your clients, you need to make sure that they're comfortable to discuss all parts of their business with you, not just situations where they've had something stolen or an employee being difficult. Like, you want them to speak freely around different types of parts of their business. Like, are they looking to move into different areas? Are they looking at acquiring a new business, selling their business, moving into a different field? Are they looking at having redundancies? Are they looking at growing or doing some capital raising? These are all things that will be handy as part of our management liability. So we'll move on to the next page, and I'm going to hand over to Susie, who's going to go over a couple of claims examples for us.
Thanks, Brenton.
You're welcome.
So we'll talk about our first claims example, which was under our employment practices liability. Our crime. So employee theft and customer or contractor crime extension. So the insured operated an insurance broking business. The insured was engaged the director's mother as an independent contractor to perform the bookkeeping and accounts administration services. At some point in or around July 2021 or February 2022, the mother allegedly became the victim of an online unclaimed funds scam. In essence, the fraudulent actors falsely claimed that they needed the mother's assistant to access these unclaimed funds, and then convinced the mother to transfer the money to or for the benefit of the fraudsters in order to assist with that process. So the money was stolen by the fraudsters, who then made various threats to the mother, including her life and liberty. So in this actual claim, we paid $122,946.50 and $4,650 in costs and disbursements. So the insured paid a fraudulent invoice. The claim is for the loss of money which the insured suffered as a result of the payment being made to satisfy the fraudulent invoice. So the claim is defined in the policy as a demand by a third party. So the claim does not fall within the policy's employment theft and customer or contractor crime extension, as there is no fraudulent act. So within our ML proposal form, we do have a set of questions around fraud control questions. So it's essential for any business to ensure that, there is dual signature payments, if they do have it, if the company does have the dual signature on payments, this is the obvious way of reducing crime losses. So if the insured has ticked no to the dual authorization or segregation of duties, what I often do is ask the broker what alternative fraud controls they do have in place, because essentially, as an underwriter, I wouldn't consider providing crime cover for a company that didn't have some sort of fraud prevention controls in place. And if the company does not segregate the duties, either as in separating the tasks so that no single individual can control accounting and banking or payroll activities from start to finish, again, that's not an exposure we would want to cover nor provide cover for. So we need to really understand what the company's fraud control looks like from start to finish. So generally, as Brenton touched on during the extensions under our crime, the crime losses need to be perpetrated by a customer, an employee, vendor, business associate, or a service provider. And we need to make sure the company must have at least 2 persons checking payments, refunds, and also segregation of duties between signing checks or authorising payments. That's critical for the business, and it also, you know, allows the underwriter to get in the mind of the company to ensure that, you know, there are those fraud controls in place and that we're comfortable with what the insured does have. Otherwise, we'll make the call not to offer crime in this instance if there's no proper fraud controls in place. So if we go to the next claims example, Brenton, or have we?
Yep, thanks, Susie.
That's you.
I'll run over the employment practices liability entity coverage. So this claim, we had a claimant's position was made redundant, and therefore the claimant's employment was terminated in January of 23. The insured received a Fair Work Commission FWC letter dated February 2023 that they'd been advised that there was an unfair dismissal application from the claimant. This unfair dismissal application stated that she was made redundant due to not being a registered nurse after working in a full-time position with a HR background, and this was going on for just over 12 months. The claimant was seeking compensation against unfair dismissal and discrimination against her medical condition. We were involved from the get-go with this claim, so we were able to get our claims team and legal panel on board to help with negotiations. The matter went to a conciliation conference and luckily was settled below the excess. So our policy, although we were along for the ride in terms of claims and legal costs, there was actually no payout paid by us because it was below the excess amount. Another example, this is there was a claimant that was employed as a full-time firefitter. The claimant's employment was terminated in December of 2022, and they were advised that their termination was due to a redundancy, and the redundancy was as a result of restructuring their businesses and their different stores. Fair Work Commission was sent a letter in January 23 that they had received an unfair dismissal application from the claimant. After being dismissed, the applicant found that there were several advertised positions for the entity and that the applicant believed that they could have been very easily redeployed into other areas of the business and other locations. The matter went to a conciliation conference again. Once again, we were involved fairly early on with these claims, which meant that we were able to get our legal panel and claims team to go in and help with all of the negotiations. And the matter went to a conciliation conference and was settled for $1,400 above what the excess amount was, which makes it around about a $12,000 claim. There are 2 examples under the employment practices liability. And I'm going to now go on to the next claim situation, which is in relation to implications of non-disclosure, which we touched on previously, very briefly. This is a matter where we are not talking about disclosure of a claim or a circumstance. This is in relation to non-disclosure of business structures and conflicts of interest. This matter was originally involved a claim for unfair dismissal by one brother against another brother. The 2 brothers had started a business back in the 80s and were extremely successful. Over the coming years, one of the brothers wanted to expand the business and was out actively seeking different areas that they could grow their business in relation to like food, real estate, clothes manufacturing. So they were really trying to. He was really trying to diversify the businesses that they had. Tensions started to reach boiling point when brother number one fired brother number two's son, so fired his own nephew. The two brothers got into a very heated interaction, and the second brother ended up getting banned from the premises. The second brother took this as an unlawful termination and sued the first brother. As part of the bundle of evidence, the second brother submitted as part of this investigation. The first brother had conflicts of interest. It was revealed, that the first brother had conflicts of interest regarding one of the investments he had made. So previously, the first brother had loaned himself a large sum of money to invest in his own company, so not with the brother, so invest in his own company that was in direct competition with the business that the two brothers had set up. The second brother brought this to the first brother's attention previously when he discovered what was going on and raised his issues and concerns about the brother doing this. As I said, loaning money from an established company to set up a direct competing company that the other brother wasn't part owner of. These allegations were brought to light prior to us receiving the submission and us coming on board, but this was not disclosed to us as part of the submission. When the claim arose as part of the claims investigation, the underwriter in question was brought into supply details around their thoughts and views and what information had been provided to them. It was made very clear to us that we'd never been made aware of any of these allegations. And the underwriter had stated that had they been aware about the conflict of interest and the subsequent internal loans, that we wouldn't have considered to offer terms. There would have been no quotation issued, and we would subsequently have not bound the policy. We were able to prove and back this up by way of our underwriting guidelines, along with clear examples of quotes, new business quotes where we have actively declined to offer terms due to similar scenarios occurring, and had some examples of policies where we had actually actively come off risk because either during the policy period or at renewal, these things had been disclosed to us. With this one, we basically went down the route of non-disclosure. The policy ended up being cancelled mid-term, and a full refund of the premium was offered back to the insured for them to go and seek a policy elsewhere. This one is a really good example of why it's important for you guys to know your clients and not just get them talking about claims and their activities, but get them to openly discuss what's happening with their business. As I mentioned previously, are there any changes, not just to the way that they're running not just the way that their activities are done. Are they looking at growing their book? Are they putting on new staff? Is there going to be a merger? Are they looking at acquiring a new business? Are they looking at being acquired? All of these things are really helpful. So getting to know your client and getting them to be comfortable with communicating with you openly and freely is paramount. Because as mentioned previously, management liability policies have a lot of moving parts to it, and it's not as clear as like liability and PI. Like I've drawn the wrong plans as an architect, I'm going to get sued. There's lots of employment clauses, tax clauses. All of these types of things can change the decisions that we make in terms of how we underwrite risks. So make sure you open those channels of communication with your clients. That will help you and it will help us.
And I think the reason why we chose this particular claims example was to highlight, the importance of disclosure. Wasn't that right?
Yeah, correct.
Yeah, just to ensure that, your client understands that if in doubt, just tell us, just tell tell you guys, tell the broker what we need to know.
And that's a really good point, Susie. Going back to what I said earlier, is getting them to be comfortable to tell you anything and everything. It's better. We would rather see insureds contacting you to say, hey, something's gone on, not sure if this is something that we should be advising you of. And then if you're able to identify that, yes, it is potentially something that could be notified on the policy or it's not, we would prefer you to be a prudent notifier of things and issues that are happening with businesses than not do it and have some disclosure issues going on. That can get really messy for all involved.
And
did you have anything to add there?
And it just highlights, don't do business with family.
Yes, it definitely does highlight. All right, well, that's we're getting close to the end. We've actually made some really good time there. We're going to hand over to Sean and Mel for any of the questions. I can see that the Q&A has had some stuff going on there, and they will answer a couple of questions here.
Hi everybody. Just look on the questions we've got a few on outside of directorship and notifications. So like Brenton just said before with the notifications, just let us know straight away so we can review them. But there are still quite a few questions there that we're getting through. So if we don't get to you right now, we will attempt to come back to you as soon as possible.
Excellent, thanks, Sean. Now, just on this slide here, we've got some product training events coming up in some states. Victoria has just done one recently in Geelong. However, South Australia, Queensland, and New South Wales have got them coming up in July and August. Just need to make you aware that there are 3 CPD or CIP points available for this training, and you can either register via the Berkeley Insurance Australia website or contact your local underwriter and tell them you're interested. They'll get you on the list for these product training events. These are the ones that we've got registered in at the moment. My understanding is there's potentially going to be some more coming in the future at different locations. And we just want to thank you for your time this morning. We hope we provided you with some helpful and useful information that you can share with your clients. If you do have any additional questions that we haven't been able to either get to on the Q&A, or you want to just come directly to us and ask some questions, please send this out to your local underwriter. If they don't know the answer, they'll find the answer out for you. But yeah, we welcome any questions around any of the points of a management liability policy. We appreciate that they can be a little bit confusing at times. But that's it from us. So thank you all for joining us.